Welcome to this mini course on data fees put on by OTA Tax Pros. Many students wonder if they're paying too much in data fees, and yet many more are completely unaware that there may be ways not to overpay. We hope to increase your understanding and to help you learn what are data fees, where do these data fees come from, and factors that impact how much you pay for data. Just a reminder that this webinar does not constitute advice and that webinar participants are encouraged to contact us at OTA Tax Pros to schedule a consultation. So today we're going to talk about the history of market data, the major players in the data market, professional versus non-professional designation, and alternatives and solutions to help you save money on your data fees. My name is Thomas Jones. I'm the tax manager here at OTA Tax Pros. And at OTA Tax Pros, as a division of Online Trading Academy, we offer specialized one-on-one services for OTA students, ranging from forming trading and real estate entities to setting up self-directed retirement plans and bookkeeping to preparing taxes for students from all walks of life. So if you're interested to get started, you can schedule a consultation with us where we'll lay out a game plan to help you reduce your risks and save taxes. So why are data fees such a popular topic among students? Well, because they add up. Let's just compare two different packages, professional versus non-professional. So I'm pulling these from TradeStation's websites, and as a disclaimer, I'm not a TradeStation rep and we don't promote TradeStation, so I don't really know what promotions, offers, discounts, and bundles they might have, so don't use these numbers as you talk to your rep. I would just refer you to TradeStation's websites. But just to kind of walk through the numbers, we can see on the left, as a professional, this might be someone who's a hedge fund trader or works for a bank, but a professional trader paying professional data fees would be paying close to $45 for New York Stock Exchange data, $150 for NASDAQ. Forex is generally free. Futures and indices would be $64 and $15. And when you multiply that out over a whole year, you're looking at close to a little bit more than $3,000 per year. On the other hand, a non-professional, this might be just my mom, for example, who just opened a trading account and is a novice trader and trading for the first time. Her as a non-professional, she would be paying $1 for New York Stock Exchange, $16 for data from NASDAQ, and if she's also doing futures and had data for indices, another $21 and $2 there. Again, Forex data is generally free. So multiply that out, 12 months, you got $480 per year in data fees, a huge difference. And as you can see, depending on which data package you select, what asset classes you trade, and whether you're professional or non-professional, can be the difference of thousands of dollars. So the history of stock market data. Market data goes way back to medieval times. The earliest stock exchanges in France and Italy was written by scribes and sent by courier. Supposedly, in the early 1800s, Reuters sent data by carrier pigeons between Germany and Belgium. By the 1860s, the New York Stock Exchange was known as the Big Board. They'd gone from carrier pigeons to using chalkboards, and the Big Board was the name given to the New York Stock Exchange because of the many chalkboards used to exchange price data. And while not the first time stock prices were published in newspapers, it was around the 1880s that the Wall Street Journal got its start. In 1863, the stock telegraph printing instrument was invented, which sent data across the country from exchanges to brokers. These stock tickers, or ticker tape, slowly improved and contributed to increasing trade volume. But when the stock market crashed in 1929, trading volumes were so high that the tickers fell behind, which contributed to the panic. So it was around this time that the teleregister company stepped in with electronic displays called automatic quotation boards. And these boards, which automatically sent current data on selected stocks, would convey this price data to brokers. By the mid-1960s, most brokerage offices had them, but current price data to these boards was still delayed by 15 to 30 minutes by the time it reached the broker. So in 1960, that's when the Quotron was invented. The Quotron, which was a small desk computer, allowed the computer to read historical price data from magnetic tapes. As computer technology improved, so did the timeliness and depth of data. When NASDAQ was originally founded in 1972, it was meant to be it was originally designed to be an electronic quotation system, an exchange that was fully set on providing timely and accurate data to brokers. So major players in the data market. Data is created not only by exchanges, but also by traders and market makers. So it's important to visualize how the data flows between everyone. Just a couple examples of exchanges. The most popular and the largest ones for equities and equities options is the New York Stock Exchange and NASDAQ. For Forex, there's not really any main exchanges, and we'll talk about why in a second. And for futures and futures options, you have everything from the Chicago Mercantile Exchange, the CBOT, COMEX, NYMEX, Eurex, all depending on which commodities and market you're trading. You also have market makers, TradeStation, TD Ameritrade, Fidelity, Charles Schwab. Maybe not, they might not all be market makers, but typically those are brokerages. All these different trade routers, order routers, they're helping contribute to the data that's created and that affects the price of a current security that might be trading. Other traders also contribute to data being created and shared. You're looking at institutional traders like banks, hedge funds, insurance companies, pensions funds, mutual funds, retail traders, day traders, and individual investors. And most often when we think of a market, we first think stock market. But both the stock market and the commodities markets are centralized. Centralized meaning there's like a central exchange. Now, it can be a little misleading because as far as I know, there really isn't one single central exchange that receives orders and data from all sources. The New York Stock Exchange and NASDAQ are both central exchanges for equities, just like the CME, the CBOT, and Eurex are for central exchanges for commodities. But these exchanges receive orders from floor traders and other exchange direct traders, which creates price data. Market makers, also known as liquidity providers, may receive and fill an order without ever routing it to the exchange. Your broker may work for a market maker. So when your buy order gets routed to a market maker, the market maker may sell you that stock that you're asking for at your asking price, even if the current price that it's trading at the exchange is different. This creates data, and market makers send this data on to the exchanges. So all this data is consolidated by the exchange and then sold in packages to vendors who then provide the data to subscribers such as yourself and other retail traders. So one of the main differences between trading stocks versus Forex is that Forex trading happens on a decentralized exchange market. Unlike stocks where one or two exchanges monopolize the market, each country has its own central bank with unique fiscal and monetary policies. And these banks the major banks deal directly with the central banks and create forward exchange contracts, futures, currencies contracts, and provide platforms for spot trading foreign exchange pairs. And then with the major banks, you have commercial companies like Disney, Coca-Cola, and Nike that work with these major banks to create forward exchange contracts and hedge portfolios to protect against adverse price movements in local currency of their foreign operating segments. An example of this is if Coca-Cola were to receive a large order for soft drinks in Japan. Let's say the contract may likely be in Japanese yen, equivalent to 10 million USD, US dollars. But let's say that the contract, it's not payable until delivery, which is scheduled for 1 month later. So in that meantime, there's a lot of risk that might happen if the dollar were to strengthen or weaken against the yen during that month. So Coca-Cola will go to the bank and negotiate a forward exchange contract to protect the value of their contract. So in case the USD weakens against the yen and the contract only pays out the equivalent of $9 million US dollars after conversion, the bank will pay out the $1 million difference per the forward exchange contract that they made with the bank. So this is an example of how commercial companies are heavily involved in foreign exchange markets. You also have large speculators, investment funds. They also use Forex contracts with banks to hedge against or capitalize on international events. ECN brokers and market makers provide platforms and options for retail traders to either spot trade or use futures contracts to trade currencies. Generally, retail traders don't deal directly with any major bank. that requires a specific agreement on hand with the bank that you would be investing with. So for the most part, retail traders, forex traders are going to be dealing directly with a ECN broker or a market maker. So all these different transactions affect current price, and no single centralized exchange really consolidates all the data between them. So because of this, data is generally shared freely between the players, which is why forex data is typically free of charge. Now, for many traders, data fees are minimal, not an issue. For others, data fees become thousands of dollars a year, and they might be paying too much. Securities regulation requires exchanges to provide data to non-professionals at a lower rate so that trading with real-time data does not become cost prohibitive for individuals. However, interpretation of who is a non-professional versus a professional is left up to each exchange to define. In the simplest definition, a professional is anyone compensated or incentivized by someone else to perform a service. So the platform data you receive from your broker is actually provided under subscriber agreements with each exchange. For example, if you have an account with TradeStation, you actually have a agreement underneath, or you're part of an agreement that TradeStation has with New York Stock Exchange for the New York Stock Exchange to provide data to TradeStation, which provides data to you as a subscriber. So these contracts can be very complex and long in length, but they define the terms and conditions of the data. So in general, even though the exchanges each have their own definitions, the exchanges agree that a non-professional data subscriber, a trader, must not be a member of any exchange or registered or qualified or engaged as an investment advisor or asset manager. They cannot be registered or qualified with the SEC or any other regulatory body or acting on behalf of a brokerage, bank, or investment firm. So in general, if you're a professional, if you're compensated, you're probably a professional. Data must also solely be used, in the case of a non-professional, the data must solely be used for professional or private use and be limited to managing the subscriber's own assets. So under those guidelines, most traders are non-professionals and qualify for the cheaper data fee rates. However, here's the crux of the problem. What if you trade through a LLC or corporation? Many traders have found tremendous savings through incorporating their trading activity with either a LLC or corporation structure. Regardless of whether they're profitable yet, trading entities have different rules regarding timing of mark-to-market elections, setup expenditures, profit and loss allocation, and more. But when trading through a company, a lot of times brokers may look at the data as being used for a business. Does that make a trading entity a professional? So let's take a look at the rules set by the Chicago Mercantile Exchange, or CME, which is a common exchange used for futures trading. As we go through these examples, keep in mind the vendor refers to the broker or platform. In a case of if you're trading with TradeStation or TD Ameritrade or FXCM, these are all data vendors. You as a trader, retail trader, you are the subscriber. So the CME uses a simple one-page form for non-professionals to self-certify themselves as a non-professional. The non-professional subscriber must have an active futures account, be an individual, natural person, or a small business entity, use the data exclusively for personal use the data to trade only their personal assets, not be a member of any exchange, not be a registered trader or advisor, and not be acting on behalf of a financial institution such as a bank. That's it. It's simple. I love it. And for that reason, we rarely hear about problems about incorporated OTA students opening up futures trading accounts as a non-professional. So if you're only trading futures and you're only trading Forex, you're off the hook. This probably isn't going to be an issue for you. Now, when we look at equities data, the two big providers are the New York Stock Exchange and NASDAQ. Their agreements are similar. If you're opening an individual trading accounts, there's not really any problem. But they use different words to describe whether a non-commercial organization or a small business entity qualifies as a non-professional. Also, the New York Stock Exchange non-professional agreements only is 5 pages, and the NASDAQ's is a whooping 20 pages of details, nuances, and legal clauses. So just to take a quote out of each one, this comes from the NASDAQ Global Subscriber Agreement. It says, non-commercial organizations solely owned by an individual and members of their immediate family who themselves are non-professionals, utilizing the market data solely for their own personal investing, may qualify for non-professional rates. And again, that may is really left up to the broker to determine and to interpret whether you qualify as non-professional or professional. And then his next quote comes from the New York Stock Exchange non-professional subscriber policy. It says, non-professional subscriber refers to any natural person who receives market data solely for his or her personal non-business use and is not a securities professional. Now, just to clarify, in legalese, the term natural person refers to a human being, since an entity such as a corporation is also legally considered an individual. Now, there are exceptions to this New York Stock Exchange policy. In their non-professional subscriber policy, the New York Stock Exchange does allow certain trusts, trading clubs, day traders to self-certify as non-professionals. And the New York Stock Exchange has commented, again, it is the vendor's or the broker responsibility to properly classify the status of a subscriber. So this is where it kind of gets gray, and depending on which broker you use, it's up to them to say whether you are a professional or non-professional. And some of the brokers might have already defined policies that might be stricter than what the exchange policies and rules are. Now, this can also be tricky for brokers to walk the line and interpret New York Stock Exchange policies on this matter, because the exchanges, New York Stock Exchange, for example, reserves the right to audit the data usage and fees charged by a vendor. And if the vendor has been determined that they were in non-compliance, the New York Stock Exchange, for example, will charge penalties for non-compliance with non-professional policies. In other words, if they were letting everyone pay only the non-professional rates, then the people who really should have been charged professional rates, that difference, that's going to be a penalty that the vendor has to pay to the exchange. And even going to maybe in a more extreme step, if they were completely disregarding their agreement with the exchange, in theory, I suppose the exchange probably even has the right to terminate their relationship with the broker, ceasing to provide data, which would literally put the broker out of business. So here we see smaller, newer brokerages may interpret the non-professional rules more conservatively in order to protect their right to provide data. But there does seem to be varying attitudes between brokerages towards professional data fees, and some larger brokers will even provide free or discounted data for accounts that meet certain criteria. Now, we would all love if the exchanges or this SEC would just provide more clarification, and this is not a new issue. Petitions have been made for years throughout the industry on all levels for improved clarification and more lenient exceptions to the professional versus non-professional rules set by data providers. So let's just bring it all together. It first starts with qualifying for the basic definition of a non-professional. Someone who's not paid to trade and is trading their own money. So you're a trader type, you're a non-professional trader. Then it breaks out by the type of trading account. Individuals, most trusts, trading clubs, day traders are automatically by default non-professionals. Trading companies, however, require further clarification. Sometimes I hear a student ask, well, I'll set up the trading business, get the tax deductions, but keep trading in my personal account. Well, it doesn't work that way. It'd be great if it did. But in a situation where the trading income is reported by a third party, the broker, to the IRS, you receive a 1099 from the broker that is required to be reported on the tax return of the account owner. In other words, in short, if the 1099 goes to your social security number, it goes on your personal tax return. If it goes to your EIN or your employer identification number, which is the business's tax ID number, then it gets reported on the business return. And most businesses won't be able to deduct the bulk of their expenses without any business activity. So for business accounts that only trade futures or Forex, there shouldn't be any problem certifying as a non-professional, as we saw with the CME agreement. However, for equities and equities options traders, it goes down to which exchange you're trading. And just to back up, if you're an options trader, it is important to note that trading options on futures or commodities is treated as trading futures. However, if you're trading options on equities, you'll be treated as trading equities or equities options. So not all options traders are treated the same. Now, since the New York Stock Exchange is the largest stock exchange and provides the most data and most options to trade, it would it would feel silly for a serious equities trader to choose to opt out of receiving data from the New York Stock Exchange. However, I have heard some students say the strategy is the same and they can find securities listed on NASDAQ to trade if it means saving a few thousand now. And then down the road, once the trading becomes more highly profitable, then they can add the New York Stock Exchange, and they'll actually opt out of data fees for the New York Stock Exchange and just trade on NASDAQ. So there's definitely some strategies here. But for many traders, if you're going to be trading options or equities options, there's a high chance that your broker might decide that you are a professional if you're trading through a business. Now, for many traders, especially the many futures and forex traders, qualifying for the cheaper non-professional data rates should not be a problem, regardless of whether you're trading via an LLC or S Corp. So, what am I saying? Well, if you plan to only trade futures or forex, don't sign up for real-time equities or options data in the first place. But what if I want to start trading stocks because that's what I'm used to? Then once I learn a strategy, switch to futures. I hear that often. Along with all the other great reasons to start trading futures now, this is one to add to the list. However, if you still want equities data to at least see the charts and ETFs, I'm all for that. Most brokers often will offer free delayed data packages. The data is only delayed 15 minutes, and your broker may even let you sim trade with the data. Now, note, you can't live trade with delayed data. The exchanges require you to have real-time data to trade on its exchange, but you at least have the ability to chart and sim trade. So definitely consider using a delayed data package. Also, I wouldn't bring this up with your broker or platform rep until they show you the data fees. I've known many reps who they get it. They figure you're a non-professional and give you the data rate without the non-professional data rate without asking for it. So I wouldn't suggest bringing this up in the first place and waking a sleeping dragon, especially when you could kind of tiptoe around it with no problem. So don't bring up the issue of, am I going to be charged professional data rates? Another reason why you might want to just leave it for them to decide and then discuss it once they bring it up is because I think some reps are commission based too. So if you bring up professional data fees, which equates to larger commissions to the rep setting up your account, they may be biased towards charging you those professional rates if they feel like you could afford those rates, because that equates to more money in their pocket. However, if the rep has already broken you the bad news and shown you an increase in fees, then simply explain that the trading account is for a private, non-commercial organization and that you are a non-professional trader. Most personal trading companies don't and probably aren't structured to conduct business, i.e. commerce, with other individuals. Plus, the term business often is indicative of commerce. So describing your trading business or conducting commerce, those are kind of terms that will set off the red light. Oh, this person's a professional. So avoiding that term. So describing your trading entity as a private non-commercial organization and you're a non-professional trader may be all it takes for your broker to classify you as a non-professional. Sometimes the rep may request, or we may suggest, if there's questions, that you submit a self-certification from the exchange. You saw snippets earlier in some of the earlier slides from those self-certifications that the exchanges have. So the broker has something on record saying that you're a non-professional. Sometimes we come to that bridge, and that's definitely something we help a lot of our clients with, is providing the documentation that the broker might be requesting. But sometimes if you run up against a broker with an unbending policy, then ask if you can opt out of the data and trading certain exchanges like the New York Stock Exchange. And I would also say, don't go all in until you're ready to start trading every asset class. It really hurts me inside. Sometimes I've seen students who pay for years of equities data. We're talking thousands of dollars because in the future, they wanted to trade stocks, but they just weren't ready yet. You're paying too much. So don't go all in until you're ready to actually trading, every single asset class. Now, as a last resort, if you can't get around the data and if it's really a deal breaker, shop around. Some brokers offer free or discounted data for premier clients, and you might find out that your broker was really charging fees that were astronomical compared to what another broker might be charging. So again, some brokers offer free or discounted data for premier clients or accounts that meet specific requirements. Plus, you might actually find a better platform for trading equities and options than the one you're currently using. Now, if you're confused, overwhelmed, or not sure, don't worry, we're here for you. As you can tell, we're very familiar with data fees and tax rules, and we'd love to help you save some money. You can call us at 855-682-7767 or email us at info@otataxpros.com. And I hope this has been helpful. I'd love to hear any feedback or questions you may have. If you haven't already met with us for a tax consultation, I highly recommend it. Sometimes we hear students say, well, my instructor or another student said I shouldn't worry about setting up a company or don't worry about taxes until I'm profitable and making money. I literally cringe inside every time I hear this, and you should consider the qualifications of your source. I say once you have an idea of what you want to trade, the sooner we can connect, the sooner we can put together a tax-saving game plan, the better. There's many deductions and opportunities you might not be aware of, and some of those are time sensitive and might disappear if it was too late. So it's better to have the right information and start off on the right foot. Now that's all for today, and I hope to hear from you soon.